Let's talk about the 401k. If you were with me on the last video in the Millionaire in the Mirror series when we talked about the three-circle financial plan, we're now going to talk about that top circle, which is our investments. And that's where our 401k belongs in that series. Let's talk about some of the history of the 401k. It started in the mid 80s and started to gain more and more momentum as it grew. A lot of companies did away with their pensions and went to a 401k type retirement where they did a match. This was good for the worker because they were more portable with their retirement. So they could, if they wanted to change jobs, they could and take that retirement plan with them. So when we talk about retirement plans anymore, we usually talk about the 401k. There are still a lot of pensions out there. There are still some companies that have stuck by their pension and maybe have a 401k that's also attached to that, where the worker probably is putting in 100%. So that's our world now. The 401k is dominating in the retirement arena. But for right now, let's talk about the 401k, the pros and cons. So a couple of the disadvantages of the 401k is that your money's locked in till you're 59 and a half. Once that account starts to grow, 100% of that is taxable when you begin your distributions. So if you have to take it out before you're 59 and a half, you're going to have a penalty, and it's also going to get added to your taxable income. One of the biggest disadvantages I see right now is that the government is changing the rules after we have these 401ks established and funded. Some of the advantages of the 401k: number one, the biggest advantage, payroll deduction. If you don't see it and it goes into an account and you can't really get your hands on it, that's a huge advantage for you because that's going to sit there and grow. One of the other advantages is it's taken off your gross income, your gross taxable income. So if you put $1,000 in your 401k throughout the year, you're going to deduct $1,000 off of your taxable income when tax time comes. And that account will grow tax deferred until you start to take out those distributions. Hopefully after 59 and a half, because that's when the government penalty is lifted. Also, one of the other advantages is when they came out with Secure Act 2.0, the 2.0 allows now for employers to offer a Roth 401k on payroll deduction. That's huge because now, yeah, you're not getting that tax advantage on the front end. You're never going to have to pay taxes on that for the rest of your life. Now, I want to take you through this hypothetical 401k. I'm showing that on the screen. So this is on a person named July Cash. She's got a $60,000 annual income. And to the left side of this sheet, she's putting away 4% out of her income. The company's doing a 4% match. So that equals $2,400 plus $2,400. So she would be putting away $4,800 a year out of her $60,000 annual income. And she would actually get to reduce her taxable income by her deduction of the $2,400. So that's a good amount of money. And in this scenario, we've done this for 30 years. So, but when we look at the tax savings, the actual amount that she would be saving, and I've used 22% here, which is probably a little high for her income because of the deductions and the standardized deduction that she's probably getting. So I'm erring on the larger side. But if you take 2,400 times 22% tax rate, that comes up to $528. If you multiply that by 30 years of doing the 401k, that equals $15,840. Now, that's your total savings for the employer match side of this equation. Well, that account figured at 4% interest, which again is very conservative, would have grown to $290,574. Now, when you look at that now, that $290,000 is now 100% taxable. And the tax savings that the government gave you was $15,840. I leave that up to you to decide. Is that a good option for yourself? If you ask me, I say yes. If the company is doing a match you've got to go to the match. I don't know where you can get 100% on your money in the first year by doing the match. Plus, it does give you a little bit of tax advantage. But when we go to the right side of this example, this employee decided to put in an extra 6%. So she would be putting in a total of 10, but there's no match on this extra 6. So her extra deduction, which she would get to take off of her taxes, is $3,600. Her tax savings of $3,600 times the 22% will be $792. That's $792 times 30 years is $23,760. And that side of the equation, because we didn't have a match, gives a total savings for that 30-year period of $217,931. So again, is that tax savings over a 30-year period, is that worth putting that money in a situation where it's locked in until you're 59 and a half, where the government can change the rules along the way? If you need money before you're 59 and a half, there's penalties. If you take a loan against that 401k, you can pay it back within a 5-year period. But if you don't, then you have penalties, plus you have to add that to your taxable income that year. It's a huge penalty. Usually taking money out of your 401k doesn't work so good. So that's where we step in, and we've got an alternative where maybe you want to put in 6% total. Our alternative we'll talk about in future videos, but it's a place where we can put money, have it grow tax deferred, and as it stands right now, never be taxed ever again. And those are options that we'll explore with you as you become more familiar with our Millionaire in the Mirror series. So if you liked what you heard, please subscribe to our channel. Please like the video, and we've got contact information for you at the end. Please go to our website and register. That way you'll always get our most up-to-date information and our most up-to-date videos. Again, my name's Judd Tolmen, president of Tolmen Financial. Look forward to hearing from you or seeing you soon.